Hello everyone, and see Deven Baviskar. Today we are going to see together valuation of futures. Okay, so there is this prevention of arbitrage principle through which we are going to price a derivative, or for this case, rather say futures. So, as per this principle, price of a derivative should be such that there is no scope of arbitrage. So price should be determined in such a way so that no person should be able to gain any arbitrage profit. Okay. This principle is called as prevention of arbitrage principle. Calculation of futures price in theory as per this principle is called as theoretical futures price. Okay. Let's just understand this prevention of arbitrage principle. Okay. Now let's understand this prevention of arbitrage principle through an example. Okay. Now there's a person whose name is Chota Chetan. Okay. Now let's say there's a person named Chota Chetan. He wants to buy shares of a company whose name is Fir Ferry Limited. Okay. Now there's a person named Chota Chetan who wants to buy shares of a company named Fir Ferry Limited. Now this share is priced for ₹1,000 in the market now. Okay. As I'm writing for spot prices. Spot price means the current market price of the share. Okay. Now this spot price of the share is ₹1,000 suppose. Now Chota Chetan is bullish on this share. Okay. He thinks that in 6 months this share price is going to rise a lot. So he wants to invest in it. Okay. But Chota Chetan does not have any money. So he's going to borrow money. Okay. So we'll need ₹1,000. How much will he need? He will need ₹1,000. Now, let's say in the market for 6 months, there is an interest rate of 10% flat for 6 months. Okay. So interest amount will be ₹100 on this ₹1,000 for 6 months. Okay. So what now he will do? He will borrow ₹1,000, buy share of Fir Ferry Limited, and after 6 months repay the principal and sell the share. Okay. What he will do is borrow ₹1,000, repay along with interest ₹1,100. Okay. And here he will buy share of ₹1,000 and sell the share. Okay, so whatever the price is, let's call it F. Okay, the price in the future, let's call this price as F. Okay, now as per the principle, this F should be as such that there is no possibility of any arbitrage gain. Basically what this means is this price should be such that it is equal to outflow in this case. So basically when we are going to borrow money and buy the share, which the repayment amount of which comes to ₹1,100 after 6 months, the futures price should be 1100 only. If it is lesser than this or more than this, then any person can gain that difference wala amount, which is called as the arbitrage amount, arbitrage gain amount. Okay, this is called as the prevention of arbitrage principle. Okay, now as there is this interest cost, there might be another case. Let's say Fir Ferry Limited has decided to give away a dividend of ₹50 after 6 months. Okay, so the price that basically the amount outflow after 6 months is going to be 1100. However, my income is going to be ₹50. So basically my net outflow in case of dividend would be 1100 minus 50, which comes to ₹1,050. So when it is the dividend, when it is return, we're going to deduct the amount and come at this cash outflow. Now in this case, the futures price should be 1,050 so as to not allow any arbitrage gain. Okay. So basically what we are doing, my dear friends, is for the calculation of futures price as per this principle, we're taking the spot price today plus we're adding up the interest, or let's call it cost of carry. So basically what is interest? To carry the funds for the particular period of time. Here in the case it was 6 months, and the cost of that carrying that amount for 6 months is ₹100. Therefore it is called as cost of carry. Okay, we will add that up. Cost we will add, and we will reduce the dividend amount. Okay, we'll reduce the dividend. Now this is what we're going to use under the principle of prevention of arbitrage. Okay, fine. I hope everyone is clear on this. This is what the prevention of arbitrage principle is, and this is how the theoretical futures price we are going to calculate. Okay. Now this model that I have already just now I explained you is called as cost of carry model, and this is its formula. Futures price is F is futures price as the spot price, cost of carry which is your interest, and minus returns, whatever you earn on the investment is reduced. Okay. Now this interest that we have calculated over here, I said to you that it is 10% flat for 6 months, but there are really three cases that might come up in this case. One is simple interest. Sorry, I have written it over here. So these three cases are here. Okay. For three cases, there might be simple interest, there might be compound interest, or there might be continuous compounding, the E wala case. Okay. This E that we use, right? Continuous compounding. So now these three cases might be there. All right. So these are the three formulas for all the three cases. Okay. Here in the simple interest wala case, we directly multiplied the period N to the rate of interest. Here in compound interest, we of course take the power of periods that are to be used. And this is the separate formula that we are going to use for continuous compounding. Now for each of this, we will see one by one examples for interest and dividend separately so that we understand how it is exactly to be calculated. Okay. It will become very clear to you after this. All right. Now let's just proceed on to the examples of interest. Okay. Fine. What details we have now? Let's look up into this. These details will be given to you in the questions that you get. Okay. The spot price that has been given is 1000 rupees RF. Now, there's something I want to tell you. In derivatives, always use risk-free rate of return. Okay. For calculating the cost of carry. Risk-free rate of return. Okay. All right. Now, it is given as 10% per annum. Period is given as 6 months. Okay. Now, how we calculate futures price? It is spot price plus cost of carry. What is your cost of carry? It is interest. How are we going to calculate the interest over here? Nothing has been given. Okay. One more thing that I want to tell you. Please remember this. Okay. One of it is in the question, they might mention that the interest is compounding. They might mention in the question that the interest is compounded. In that case, you have to use this compounded interest wala formula. Wherever they have given you value of E or have mentioned per annum compounded continuously, and you have to use E wala formula. And otherwise, where they have not mentioned anything, you have to use the simple interest wala thing. Okay, you have to take up simple interest. All right, just remember this, please. So in this case, they have not mentioned the compounding, not E ka value has been given. So we will assume this is simple interest. Now, how are we going to calculate the value of futures? We will take up this first formula. F is equal to S into bracket 1 plus Rn. Okay. So S into 1 plus Rn. Now what is S? S is 1000. 1 plus what is your rate of interest? R. R is 10% per annum, but the period is 6 months. Therefore 0.1 into 6 by 12. Okay. Now let's calculate this. It comes to rupees 1050. This is your, my dear friends, futures price. Okay. Very simple. Very simple. Okay. Now let's just scale up a bit and come to compounding wala formula. Let's see how compounding is done. Okay. So in this case also, spot price is 1000. For your ease of calculation, I've kept risk-free rate is 10% per annum, compounded quarterly. Okay, let's see how it is to be solved. And period is 6 months. Same I have kept for ease of understanding. So futures price we are going to calculate in the case of compounding. It is calculated as 1 plus r raised to n into s. Okay, futures price is equal to spot price multiplied by 1 plus r raised to n. Now what is the spot price? It is 1000. What is r? Now r for 6 months has not been given, but it is given for per annum. It is 10% compounded quarterly. Now let's understand something. This is very important. Okay, just pay attention to this. Now in the question, suppose you have been told that the interest rate is 10% per annum, and they have said to you that the compounding of the interest rate is monthly. Okay, so for a month, let's say X% interest rate is there. So upon the value of 100, this X% will be added. Then the whole amount of this X% on the second month will be added. Then on the whole amount of this X% of third month will be added. So this is how the monthly compounding goes. Correct. So as 10% per annum has been given and the compounding is monthly, we'll need to find first the monthly rate, which we are going to calculate by this way: 1 plus 0.10 into 1 by 12. Correct. This is how we're going to find the monthly rate, which comes to around 0.833%. Okay, so this is how we are going to solve it. And for suppose in the example they have asked us to calculate the futures value after 6 months, then we will take the power of 6, because this 1 plus r wala factor comes of 1 month. Now when it is compounded annually, you cannot just divide the 10%, because the compounding is done annually. The 10% per annum, correct, is already compounded annually. In this case, what you will have to do is you will have to take the 12th power of this factor so as to arrive at the 1 month wala factor. If you want 6 months, then you will have to just multiply it by 6, or basically 6 by 12. Okay, so this is the difference that you have to understand. All right. Now here they have asked us to compound it quarterly. Therefore, what we will do is first find the quarterly rate, which is 3 by 12, 0.10 into 3 by 12, and the period is 6 months. Therefore, this factor will be of 3 months, and when we take up square for this, we will arrive at the factor for 6 months. All right. Okay. Now let's find the value of this. What is it? 0.1 into 3 by 12 into is equal to, sorry, plus 1 into is equal to into 1050.63. 1050.63. Okay, fine, easy enough. All right, great. Let's just proceed to the E wala question now. A spot price again is given to be 1000 rupees. Risk-free rate is 10% per annum. CC means compounded continuously. So when it is continuous compounding, it means you have to use that E wala formula. What is the E wala formula? F is equal to S into E raised to Rn. Let's see how this is solved. S we have as 1000 rupees into E. Now, what is the rate of interest? It is 10%, 0.10 into, what is the period? 6 by 12? 6 by 12. Okay. Now what is it? 1000 into E raised to 0.05. Okay. Now, how do we solve this? Okay. Now there's a method to this. Please note these steps somewhere. Okay. Please note these steps somewhere. Finding value of E. Okay. First step that you have to do is take this power. It is 0.05. 0.05. You have to divide by 4096. Okay, divide this value by 4096. Then second, add 1. Okay, add 1. And the third step is into equal to 12 times. Okay, now in this case, let's just find the value of 0.05, which is equal to the power E raised to 0.05. Okay, a 0.05 divided by 4096 plus 1 second step into is equal to 12 times. It comes to 1000 into 1.05127. Okay, 1000. So futures price comes to 1051.27. Okay, this is how you have to solve the EUCA example. First, you have to divide by 4096, then add a 1 to the value that comes up and multiply is equal to into is equal to 12 times. You will arrive at this value. Okay, you will arrive at this value. All right, fine. I hope everyone is clear on this part. Now, let's just see examples of returns. Dividend, as I told you, we have to deduct it. Okay. Now, things that you have to consider while solving these examples on the returns. Whenever it is returns, you have to remember that only deduct dividend received or receivable before expiry of futures. For example, the expiry of futures is September 24. Okay. And in the question, it has been mentioned that the dividend will be received in the month of October 24. And you do not have to deduct the returns in this case. Okay. Only deduct the returns which are receivable before the expiry of futures. Okay. Please remember this. Second thing, when dividend yield is given, directly reduce the rate from interest rate, the yield rate. Okay. For example, 10% is your interest rate. They have given in the question that 7% is your dividend ka yield. So while calculating that F is equal to S into 1 plus Rn, this R that you are going to take, do not take it as 10%. Take it as 10 minus 7, which is 3%. You have to directly take the net percentage. Okay, remember this. Whenever it is yield, whenever a dividend yield has been given, only in that case you have to do so. When dividend rate is given or the dividend amount is given, you have to, when the dividend rate is given, calculate dividend amount and reduce from interest amount. So either they will give you dividend yield or they will give you the rate of dividend. They might say, suppose they might give you face value of share is 10 rupees and dividend is 25%. The rate of dividend they will give. So basically dividend will be rupees 2.5 that you have to first calculate and directly deduct it from the formula. Okay, let's just go to example so that we understand what we are going to do. Okay, let's see what in the first example we have been given. What they have said is that spot price is 1000 rupees. Risk-free rate is 10% per annum. All right. Dividend received after 9 months is 200 rupees. Okay, now they have given it in the amount. Okay. Calculate 9-month future price. Okay, fine. Let's just see how we are going to do it. Okay. Now there is no compounding or there is no power of E that has been given in the question. So we will assume it is the example of simple interest. So how we are going to calculate it? F is equal to S into 1 plus Rn. Okay. So what we have to be S is 1000 rupees. 1 plus 10%. 10% is 0.10 into N. What is N? 9 months. 9 by 12. Okay. Now we have to reduce this 200 rupees. Now understand something. What is given after 9 months, the dividend received is 200 rupees. Okay. Now I am at suppose 0th month and I am at 9th month. When are we receiving this amount? At the end of 9th month, 200 rupees. Okay. When are we beginning? S is equal to 1000 rupees at the 0th month. Okay. Now we're going to carry this amount here at the rate of 10% per annum for 9 months. Okay. We will carry this amount. It will become X. Then what we will do is we will take up the net of these both values and this will be our futures price. Okay. Understand this. What we have said, what I have said is 200 they have given in the question. It is received after 9 months. So let's take it up to be received at the 9th month wala point. Now the spot price we have as 1000, we are going to cost of carry it, we are going to carry it to 9th month. Let's say it comes to x rupees. Now 200 rupees is to be deducted at the 9th month because it is received there. Okay, so the net amount that comes up here will be your futures price. In case, now suppose this 200 rupees was received at the beginning, at the 0th month. What we would have done, we would not have carried 1000 rupees here. We would have carried the net of these both amounts. What is it? We would have carried 800 rupees net at 10% to 9th month. This would have been our futures price. Okay. Now let's see examples and understand this with the help of example. Now we have received the dividend after 9 months. So at 0th month, the price is 1000. At 9th month, it will become this. Okay, after 9 months, the cost of carry including the amount will come to 0.1 into 9 by 12 plus 1 into 1000. It will come to be 1075 rupees. At the end of 9 months, we have received 200 rupees. So we'll deduct this. The amount that comes will be your futures price, okay, which comes to 875 rupees. All right. Okay. So we'll reduce it from here. Now let's change the question. Okay, let's put up some twist. Dividend received at the beginning. 200 rupees. Now how we are going to calculate it? It was 875 in the first case. Okay, now we are going to calculate it when the dividend has been received at the beginning. But the 0th month we have received the dividend. Okay, not here. So we'll have to carry this 800 rupees for 9 months. Okay, now how we are going to carry it? We'll have to net off this amount here itself. 1000 minus 200. 1000 minus 200. 800 into 1.075, which comes to 860 rupees. In this case, the futures price will be 860 rupees. I hope you have understood what this means, okay? I hope everyone understood how it is to be calculated as per when the dividend is received. Alright, great. Now let's come to the second example. The spot price is given to be 1000 rupees. Risk-free rate is given to be 10% per annum compounded continuously. Means we have to use e raised to rn. Dividend yield. Okay. Now dividend yield, how we are going to solve, we will see. Calculate the 9-month futures price. Okay. Let's see. The futures price is calculated as, in the case of continuous compounding, s into e raised to rn. Okay. S is 1000 rupees into e raised to r. What is r? 10% per annum compounded continuously. 0.10. Now what did I say at the beginning of this dividend wala thing? I said that you have to deduct, in case dividend yield is given, you have to deduct it directly from the interest rate. So we will deduct 2% from 10% and then we will put up the period wala thing. We will then multiply this net interest rate, which is of 8% by 9 months. Okay, so 8% into 9 by 12. So this power comes to 0.06. This basically is 1000 into e raised to 0.06. Okay, all right. Now let's just find this value of e raised to 0.06. What did I tell you? First step is divide by 4096. Okay, then add 1, then multiply is equal to 12 times. Okay, now let's find the value of this e raised to 0.06 into 0.06 divided by 4096 plus 1 into is equal to 12 times, which comes to 1.061836. into 1000. It comes to rupees 1061.84 approximately. Okay, I hope everyone understands how this is done. Okay, all right, students. Now I hope everyone has understood how we are calculating the cost of carry and how we're reducing the dividend wala amount. Okay, I hope everyone has understood how this cost of carry works. Okay, and how to calculate the futures price. It is very easy if you just practice it well, and we will see up examples also in the further coming videos. Okay.